lucky to have two very experienced and knowledgeable Farm Credit East consultants who will be presenting on the Paycheck Protection Program loan forgiveness provisions. Our first presenter is Erin Pirro. Erin has been helping farmers, large and small, make their businesses run better since 2001. She is a certified agricultural consultant, and she has a background in agricultural economics. Her focus is on benchmarking and profitability improvement because, as she puts it, sustainability means economic sustainability too. She is focused on agricultural retail businesses in particular and runs our agricultural retail benchmarks program. Our next presenter is Keith Dickinson. Keith Dickinson is a business consultant based in our Bridgeton, New Jersey branch office. His territory includes all of New Jersey and the lower Hudson Valley region of New York, and he also works in other areas as needed to serve clients. He works with farmers and other agricultural business owners to assist them in the planning and management of their businesses. Specific areas that he focuses on include business planning, profitability analysis, estate and farm succession planning, as well as business entity selection and management. So please join me in welcoming Erin Pirro and Keith Dickinson. If I could have the next slide, please. This is just a brief disclaimer, basically saying that this is our best interpretation of the Paycheck Protection Program forgiveness rules as they stand as of this date. Ultimately, the Small Business Administration is the final arbiter of what is forgiven. This information is presented in good faith, but we cannot guarantee that it is completely the same interpretation as what others may have. If I could have the next slide, please. This business information on the Paycheck Protection Program, as well as other coronavirus-related relief programs, is being posted on our Knowledge Exchange COVID-19 Resource Hub on our farmcrediteast.com website. I encourage you to check it out. We will have a frequently asked questions document that will be linked on this page. It is there now, and it will be updated with questions that come in during this webinar. With that, I will turn it over to, I believe Erin will be the first presenter.
Yes, thank you, Chris, and welcome everybody. Good morning. If you're just joining us, you have probably heard a lot in the news about the Paycheck Protection Program. The goal of Congress passing this act is to keep employees paid during the COVID-19 shutdown. Notice it doesn't necessarily say working, but to keep them paid. And the idea was that small businesses, including self-employed individuals, could apply for these Paycheck Protection Program loans to help cover eligible payroll expenses and really replace unemployment. There are a few other things that they could spend the money on: interest, rent, and utility expenses. So if you applied for a PPP loan and if you were approved by SBA and you spend the right amount of the funds on the right expenses in the right time period, you can apply to have that loan forgiven or partially forgiven, as we've learned. The SBA released the forgiveness rules on this past Friday, and we're all going through learning them, digesting them, interpreting them, as Chris said. And we do expect there will be some updates from SBA, clarifications along the way, but this is what we know now. So we're sharing it with you so that you can become prepared to spend the money in the right way to achieve maximum forgiveness, if that's your goal.
So the big picture from our seat here in Farm Credit East, how we see this forgiveness going. The borrowers, that's you, will compile documentation to support your application. This is the application for forgiveness that we're talking about. You're going to complete your application after your covered period is complete. We're going to explain what that covered period means in detail here in just a minute. You will submit that package to your lender, the lender that you went through to obtain your PPP loan. They will check the documents, make sure that everything looks correct, make sure that you filled out the application for forgiveness correctly. Then they're going to submit that package to the SBA. SBA will approve or deny it and let the bank know if the loan has been forgiven, which will then communicate back down to the borrower. So looking ahead, what are some resources that we're trying to put together for you as customers and borrowers under the PPP loan program? Well, first off, go to that web address you see there, farmcrediteast.com/webinars. We have the webinar that you're on today. Obviously, we had we held this same program yesterday at the same time. We've also decided we're going to start offering some office hours. This is a time for you to just, we're not going to be doing formal presentations. It's more of a time where you can log in, ask it what questions you might have on forgiveness or the PPP program going forward throughout this next couple months, as most of you will be working to get your loans forgiven. We're also planning another webinar that will focus on a little more deep in the weeds, and so to speak, in terms of what's the nuts and bolts of filling out the application, showing you the actual application form. We're looking at that's going to be more towards the end of June, early July, which will line up when many of you will be through your covered period and at the point where you can actually start filling out that application and submitting to your lender. So stay tuned on that. We intentionally are pushing that back a bit to make sure that any updates that we get from SBA will be incorporated into that so that it will be as most efficient for you as possible.
This is the first pass. Like I said before, it's what we understand right now. We do know that each lender is going to process the applications, as Keith said, and submit them to SBA. So each lender is probably going to ask for the information in a different format. So as we get that information, we will certainly share it on. It's important to understand that forgiveness is not automatic. So you do need to keep all of the documentation and the paperwork that we will go through today to submit with your application. If you'd like to get a head start, that application is available on sba.gov, or you can find it with a link through the farmcrediteast.com COVID-19 resource hub. You see that web address here. We do expect more guidance from SBA. As you saw during the loan application process, it took a little while before agricultural forms such as Schedule F and 943 were incorporated into the acceptable documents list. It's a learning curve because SBA doesn't usually work with farms. That's USDA's job. So it just took a little while. You'll hear us say more than once that patience and persistence pay off. So these things will be coming. We're just not there yet.
So I can already hear some folks saying, what are you talking about filling out an application? We already filled out an application. Yes, you did. You filled out an application for a loan, and that's what you have. You have right now a PPP loan that you might be able to get forgiven if you do it the right way. But what are the basics of this loan? Payments are automatically deferred for 6 months from the date of disbursement. So the day the money hits your bank account, the 6 months from that date would be when your first payment on that loan would be due. Now there are provisions in the rules to allow borrowers to request an additional 6 months deferment if necessary. And the way it reads, it seems as if that deferment would be fairly easy to achieve. So practically speaking, it may be 6 months, maybe even a year before a payment would be required under the loan portion of this program. Again, if, in bold letters, if you follow the correct procedures, you can apply for forgiveness. That's this application we're talking about. You need to spend the money on the right expenses: payroll, rent, interest, and utilities. I'm going to emphasize payroll. Erin's going to emphasize payroll. The more you spend on payroll, the better you will be better shape you will be in terms of getting forgiveness. At least 75% must be on payroll to achieve full forgiveness. If you spend 50% of your loan on payroll, you will not achieve full forgiveness of that loan. You will be limited in how much forgiveness you can receive. You spend it in the right time period, 8 weeks, 56 days, starting the day you receive the PPP funds. That's your time frame. So many of you are in that time frame right now. The clock is ticking. Forgiveness is not all or nothing. This is something that we were possibly concerned about based on some early language used by the SBA. But it does appear that if you do not achieve 75%, it's not going to be a pass-fail test. You will still get some forgiveness, but your forgiveness will be reduced. If you say you spent 70% on payroll and only in the other 30% you spent on those other 3 categories, you would still have 5% of your loan amount that you would need to pay back because you did not cross that 75% threshold on payroll expenses. And again, this is a loan, so anything that's not forgiven, that you do not qualify for forgiveness, or one of the many reasons you may not get full forgiveness, that is repaid over a 2-year term at 1% interest, which is, of course, a fairly favorable loan term regardless.
The clock starts for this 8-week period the day you received your PPP funds. That would be a really good thing to write down on the calendar and just highlight that 8-week period. This is what you're going to hear referred to as your covered period for the next hour, the next 8 weeks, and however long it takes you to get loan forgiveness. You cannot apply for forgiveness until you have completed these 8 weeks, because that's the time period during which these expenses are measured. And while we want to say you don't need to rush, as in you can't do it this week, but don't put off applying for forgiveness until the last minute. You do have the 6 months that Keith mentioned before your first loan payment would be due, so you do have some time. But I heard a statistic that said SBA processed 14 years worth of loans during the first round of PPP funding alone. So if that takes a lot of time to process each forgiveness application, the chances of you applying for forgiveness in the last week and getting it processed and approved before the deferment period runs out is pretty slim. So we're suggesting mark your calendars for 3 months after you get your PPP funds, and that would be the ideal time to apply for forgiveness.
So let's talk about this covered period. We've already mentioned it a few times in this presentation already. What is that? That's the amount of time you have to spend your PPP funds to qualify for forgiveness. It started the day that you got to your PPP loan funds, the day that money hit the bank. It's exactly 8 weeks, 56 days, not 57. It's not 2 months. It's 8 weeks. If it started on a Friday, if the money hits your bank on a Friday, it will end on a Thursday. So how in the world do you handle payroll when payroll very often does not align with the exact time frame that you have to spend? Well, fortunately, SBA did think of that and has a provision in there for us that Erin's going to explain.
Right. So you have 2 options here. If you choose, you can use that covered period that Keith talked about, or for payroll only, you can measure and track these expenses during what's known as the alternative payroll covered period. You'll see it abbreviated APCP from now on. It is also the same 8 weeks or 56 days. And if you choose this period, you will have to use it for all of the payroll calculations on your forgiveness application. If you choose this period, it will start on the first day of the first pay period, right after you receive your PPP funds. So if the funds hit your bank account today and your pay week starts on Sunday, this Sunday would be the first day of your alternative payroll covered period. Now, not everybody can use this time period. You have to pay either weekly or bi-weekly in order for this to be an option for you. And again, you need to make sure that you use this for every payroll calculation on the application. You also must pay your last pay run by the regular pay date, because if you use this period, you're going to accrue the payroll. The pay date usually comes a few days later or a week later. As long as you make that by its regularly scheduled pay date, that last week will still count towards your payroll expenses for forgiveness.
So what costs actually count towards forgiveness? First and foremost, payroll. If you remember only one thing out of this webinar today, it's that payroll is really important. Payroll expenses, what includes that? Well, it's the same thing that you use to apply for the loan, your gross wages to your U.S. resident employees. Now, there's a maximum that can be spent of $15,385 per employee. If you'll recall from when you applied that there was a limitation that said that any payroll over $100,000 a year equivalent to an employee was not counted. Well, that's what this $15,385 is. That's 8 weeks worth of the equivalent of $100,000 a year compensation. So I know folks are considering bonuses, extra pay. If you push someone over $15,385 during that amount, that excess will not be countable towards forgiveness. Your employer share, the part that the company pays towards your health care benefits and your retirement benefits, and then your state and local payroll taxes. That and that varies quite a bit from state to state, but that's the part the employer pays. Usually it's some form of state unemployment taxes. I know here in New Jersey, we have a couple of other small categories that the employer pays into, but it is not the withholding tax that comes out of the employee's paycheck. That's income tax that the employee pays. That's already included in their gross wages. And it does not count the employer, the company share of the federal taxes, FICA, Social Security, Medicare, or the federal unemployment tax, and workers' comp does not count. We saw quite a few applications that we worked with folks on for the loan amount that included workers' comp. That's an insurance. That's not a tax, and so that does not count. Paid and incurred, which we're going to explain quite a bit, starting with Erin at the next slide. What does paid and incurred mean? Basically, at this point, it's no prepayments. We can't give advances on pay. We can't pay our year's worth of healthcare benefits. We need to make sure it matches that 8-week time period, that covered period, or the alternate covered period that Erin just explained.
That's right. And now you can do whatever you need to do management-wise. These instructions here are what counts as forgiveness. So if someone's done a fantastic job and you want to give them a bonus and it kicks them over that $15,000 number, by all means do it. Just understand it doesn't count towards forgiveness, because we've got a couple of different things going on here. And as Keith said, we're concentrating on what counts towards forgiveness. So what counts for payroll is whatever you paid, and that counts as of the date the paychecks are distributed or the ACH is originated if you do a direct deposit. It also counts incurred payroll, which is the day the employee earns it. You can't count them twice, but it looks like if you paid tomorrow, even if you got the funds today, that would count. And then anything that is incurred afterwards. So if you have a pay date that's split across the covered period and the non-covered period, you could count those last few days because those paychecks were earned for those couple of days by your employees. So as long as it is incurred, even if it hasn't been paid during the covered period or your alternative period, depending on which one you choose, as long as you pay it by the next regular payroll date and you allocate that portion in your records, you can count that as payroll costs towards forgiveness. And again, the one tricky one is, what about it was paid but not incurred, meaning overlap from a previous period and paid in the start of the covered period or the alternative covered period? That's one of those things we say, it seems acceptable right now. Further guidance may change that, so stay tuned. Right? Plan for the forward part of the covered period, but know that you might be able to count that as well.
So what about the owner compensation? Those of you that own your businesses and work in them, which most of our agriculture and farm businesses, the owners are quite active in their business. So, and this is one of these areas that was a moving target throughout the application period for the loan amount, in that it was not addressed very clearly in the beginning, and by the end, it actually was quite clear. So we have how your compensation as a business owner will really be treated differently depending on what your actual business structure is. So our basic business structures there on the screen: sole proprietors, partners, partnerships, LLCs, and corporations. So for your corporations, I'm going to start at the bottom and work up. Your corporations, your owners pay, that salary that you draw as an officer salary in your business, that was already included in that gross wages calculation that we talked about a few slides back. So your compensation's already been counted. There's no additional self-employment income allowed for a corporation owner based on distributions or profit of the business. It's your salary, the money that you took home in your, or not take home pay, but your gross wages that were paid to yourself as owner salary. So your LLCs, it's going to depend on how you're treated, is dependent on what your tax filing status. So if you're treated as a corporation, as an S corporation or C corporation, you would follow the corporation rules. If it's a single member LLC, i.e. one owner, you would be by default a sole proprietorship or a corporation. And then finally, your partners, the partnerships, those LLCs with multiple owners, which many of our farm businesses that are multiple owner LLCs elect to be taxed as partnerships, you would follow the partner rules. So partnerships, box 14A of your K1. that form that you get that says what your allocated earnings from the business was in that partnership. There's very specific language. Box 14A, it's on the lower right-hand corner to K1. That's what you use. Each partner can claim that amount. If that number is 0 or negative, you can't claim any of it. Same thing for your sole proprietors. It's either your Schedule F or your Schedule C. And we know we had lots of issues early on with Schedule C's because that, or Schedule F's, because that the language in the SBA only mentioned Schedule C's. Remember, they don't normally work for farmers, so they probably didn't even know that the Schedule F existed until some of us told them about it. That sole proprietorship has only one owner, husband and wife businesses. There is only one owner to a sole proprietorship. It's the name that's usually printed at the top of the Schedule F or Schedule C, but it's that net income. You're capped out at $100,000 per partner per owner. So if your partnership had allocated earnings of over $100,000 per partner, you can count up to 100,000. If you had 20,000 per partner, it's 20,000. So what do you do with that number? Well, it's very clear in the SBA language. You take that number, that allocated earnings, your Schedule F, Schedule C profit, or your box 14A from your K1 for your partnerships, multiply by 8, divide by 52. That's the amount that you're allowed to count as a payroll expense towards that 75% threshold in your forgiveness amount. It's limited again to $15,385 per owner. That's the equivalent of $100,000. Now, a question that we often get: what if I did not submit a Schedule F or a K1 with my application? Unfortunately, the way we read the requirements, you must have used that in your application for loan amount to be able to claim it for forgiveness.
So what about the reporting? For owners, whether you are part of a corporation and receiving a wage, or you're a self-employed individual in a sole proprietorship, or you're a partner, you're going to need to report that income on a separate line for employees, from your employees. It all counts towards forgiveness in terms of payroll dollars, but your hours are not going to count in the FTE calculation. That is okay, because your hours didn't count when you were doing the math towards how much your loan was. That was only dollars there too. And you will also notice that as you look at the forgiveness form, you have to write the number of employees that you put on your loan application, but your forgiveness application is going to look at full-time equivalents in order to figure out how did that change from before the COVID-19 shutdown to the covered period. Those are the things that you're going to be comparing. So don't worry about your hours not being included there. One thing we are going to suggest, though, if you applied for a PPP loan with a draft tax form, have the conversation with your tax accountant to make sure that the one they actually file is going to match the one that you submitted already. Discrepancies there could cause some problems. So just something to keep in mind before you file your final tax return if you haven't done that already.
So another question we've been getting a lot of is, what about if we use guest workers on our business, our H-2As, H-2Bs, J-1s, and other guest worker programs? We've covered a majority of them. SBA, again, this was guidance that was sort of a moving target. The law and the early guidance said that payments to people who were not residents of the United States, whose primary residence was not the United States, would not be permitted as compensation to count towards the loan or towards forgiveness. So SBA did have some additional guidance that came out midstream during the application time period, but it didn't, quite bluntly, did not clear it up as much as we would like. It does not mention temporary workers, does not specifically mention H-2A, H-2B, does not mention guest workers in any way. The guidance that they refer to is a part of the IRS code section which determines which state you're a resident of in terms of where you pay income taxes, what state is your primary residence, and even more so, what state or what is your primary resident for determining whether or not it is your primary residence when you sell it, how the capital gains are applied. So it's kind of like taking an apple and saying, here, apple, you describe this orange. And it's very difficult for us to say what the correct interpretation is. So since there's no official word, it's unlikely, in our view, that many banks will expand the acceptable expenses. That's going to vary from bank to bank. So our advice, plan your PPP spending and forgiveness application without those guest worker wages.
Now, we've spent a lot of time talking about payroll because it is the Paycheck Protection Program. And we've talked about that 75% threshold, meaning that is the minimum you're going to need to spend on payroll to achieve full forgiveness. However, if you were able to spend all of your PPP loan funds on payroll, that would be fantastic and totally acceptable. So concentrate, as Keith said earlier, on payroll, payroll, payroll. However, there are a few other things that could count not only as eligible ways to spend the money, but could count for up to 25% forgiveness. These are going to be expenses that you pay during your covered period. You cannot use that alternative payroll period for these other expenses. They need to be incurred during your covered period, again, no APCP, and paid on or before the next regular billing date. So these things are rent, mortgage interest, and utilities. So a quarterly interest payment, part of it could count, the part that was incurred during the covered period, even if it was paid after, as long as you pay it before its next regularly scheduled billing date. For any of these obligations to count, though, there's a caveat. They have to have been in place before February 15th, 2020, and they must have written arrangements in place that were in place before February 15th. You can't prepay on any of these. They need to be either paid or incurred during this time period. And we strongly recommend you consider what we call the New York Times test. If it's something you'd be proud to read about on the front page of a really big newspaper, do it. If you wouldn't be proud to read about it, don't do it. Pretty simple.
So we're going to dive a little deeper into these individual non-payroll expenses. Covered mortgage obligations. So again, an area that we were unclear about what actually counted. Unfortunately, we do have some answers to some of the questions. So big picture, big business mortgage interest. So this has to be an obligation of the business that applied for the PPP loan. Has to be mortgage interest, no principal. Payments during the covered period. Remember that alternate covered period, that applies only to payroll. So it's that 8 weeks that started the day you got your money, or incurred during the covered period and paid to schedule. So Erin just gave the example of the quarterly interest payment that is due after your 8 weeks ends. Well, you would prorate that back to the amount that would have been allocated to your 8 week period, and that's the amount you put on. But you got to make that interest payment on time. You can pay it early, but it has to be made by the due date. This next line is probably the most important in the interest discussion in terms of clarification. They did finally settle on real or personal property. It has to be a collateralized loan. So your credit cards, they don't count because generally credit cards don't have collateral. It's personal guarantee. However, your operating loans, many operating loans do have collateral that is either tied to real estate or blanket liens, for example, on all your equipment and inventory. So that's a collateralized loan. It's collateralized by personal property, farm equipment, buildings, that's personal property. So that would count. So that's a good news for many of us in terms of giving us some flexibility on what counts as interest. Now, again, as we mentioned earlier, obligations must have been in place before February 15th. So if you closed on that loan after February 15th of this year, unfortunately, that will not count. But if you have written documentation that that loan existed prior to February 15th, good news, you'll be able to count that interest. And again, no prepayments. You're not going to be able to pay early on your interest. You can make a scheduled interest payment early, but only the amount of interest that was attributable to the 8 week period will be able to be counted.
Next one is rent, and it is business rent or lease payments. And the good news is it does count on both real and personal property. So if you're renting real estate, land, houses, etc., or personal property, vehicles, equipment, all of that does count as long as it was paid during the covered period or it was a part of the payment that was incurred during the covered period. Again, as long as it was paid on or before the regularly scheduled due date. Again, no alternative period counts here, only the covered period starting the day you got your PPP funds. So what about land rent that you normally pay once a year? Well, you can't prepay it and have it all count, but you can make an argument that 2/12, 2 months roughly, right, those 8 weeks, you can do the math on that specifically, will be incurred during your covered period. So if you pay that, it could count. Now, again, these obligations must have been in place before February 15th, 2020 with written documentation. So it wasn't just your farm credit consultant being pesky about putting this in writing. It's actually really going to help you out right now. Again, you can't prepay it, but you can use the allocated portion that was incurred during the covered period. And I think you're going to need to be able to show documentation that that was paid before you can apply for forgiveness. So you might end up paying your rent in 2 checks if that's the case. Now, why do we keep coming back to this New York Times test? Well, let's think about it. A lot of the companies that have been bashed in the news did follow the rules as we knew them on the day they applied for the loans. However, it didn't necessarily follow the spirit of the loan program. So I think that's where a lot of the problems have come from. So if you have rent that you pay to another entity that you own, is that eligible? If the written arrangement was in place before February 15th, 2020, and its written documentation is in place and was in place before February 15th, 2020, and you're following that written documentation and the schedule. This is not a time to raise rent. This is not a time to start paying rent if you haven't been paying it regularly in the past. Business as usual here, especially when there is the potential for the perception of something going wrong.
So our final category of non-payroll expense is utilities. And these are, again, utility payments that are attributable to the business in the name of the business that is that had applied for the loan. So the categories of utilities are distribution of electricity, gas, and we believe this is gas for heating, such as natural gas, propane, etc. Water, so if you're on your municipal water supply, your water bill. Transportation, that's the only explanation we have of what that entails. Telephone or internet access. So these are the main, and these are generally what most folks would consider utilities. Again, must be paid during the covered period. So the first bill that you receive during the covered period, that 8 weeks that started the day you got the loan, the first bill, that's countable. And you can also count anything that was incurred during the covered period and paid on or before the next bill. So if you're billed monthly and your loan started mid-month, chances are you're going to have at least 2, maybe even 3 bills that you're able to count at least a portion of in your PPP loan forgiveness. Again, they must have had that service in place before February 15th. So if you had built, say, for example, a new greenhouse range and the gas service came online March 15th, unfortunately, that's not going to count because that was not in service, not in place on or before February 15th. And you have to have that written documentation of the expense. Our utilities, we believe, are going to be the easier ones to have written documentation because these are ones that are generally with a third party that you get statements for. Many of you may use online statements that go on paperless. Well, you can always log in and get a copy of your statement that shows the expense. And again, no prepayments. You're not going to prepay your gas bill for the next 6 months. You can't write a check for anticipated electricity for the next 6 months. It has to be paid or incurred during the cover period. Not really much exception there.
But Keith, aren't fuel prices ridiculously low right now? What if I want to fill up all my tanks?
Good point. So fuel prices, what is included in fuel? We've had a lot of questions about tractor fuel. Is that a transportation expense? Well, when I worked in Pennsylvania, we had an Amish farmer that rode a skid steer to the mailbox every day. So I guess maybe sometimes these equipment pieces are transportation, but generally it's not transportation. Is it gas? Well, gas is considered heating, I think. So we're not sure, we're not really clear on the fuel for your farm equipment. Certainly if you have a tank for your vehicles that go up and down the road, that is certainly transportation and can be included. But yeah, back to Erin's question, what about filling up the tank because fuel prices are very low? Certainly, there's a business reason to do that. Makes sense to do that. But again, it has to be tied to that fuel has to be used for one of these utility expenses. Maybe we'll get some clarification on whether equipment fuel will be includable or not. We're not really sure. Certainly, if you have a heating fuel tank, great time to fill it up. I think that's going to be perfectly fine. Your gas tanks, your propane gas tanks for say heating for your business or for cooking, yeah, great time to fill it up. I think that's going to be fine.
All right, so to recap all of these non-payroll costs, mortgage interest, rent, and utilities, as we described, are eligible uses of PPP funds. The forgiveness part, though, only those count that were spent during the covered period. You don't apply the alternative period for other expenses. You have to pay these during the covered period or incur them and pay them on schedule. And you are going to have paid them before you can apply for forgiveness because you're going to need to be able to document that. These obligations or services must have been in place prior to February 15th, 2020 with written arrangements that were in place before that time period. And you're going to need to provide those as documentation. Keep in mind, these non-payroll costs are not eligible for more than 25% forgiveness. So that's why we keep saying, go back to payroll. Spend as much as you possibly can on payroll, and that'll help you count as much as possible of these other expenses if there's anything left in your loan.
So how do we calculate the forgivable amount of our loans? It's basically 3 steps. First step was we figure out what our eligible costs are. All these expenses that we've been talking about the past several slides, our payroll or non-payroll expenses. Then we need to adjust for the reductions. We haven't talked about the reductions yet. We're about to get into that. There's a Schedule A on the worksheet that we'll refer to. There are 2 main categories of reductions for wage and salary. If you have any employees who got a pay cut over a certain threshold during your covered period, that's going to reduce the amount that can have forgiven. And there's also a reduction for the number of full-time equivalents. How many people do we have working relative to certain reference periods, which we'll explain. If you got an EIDL loan, now there's been a lot of news about the EIDL loans in the ag community here recently because the second round of funding, EIDL loans were available to farmers, which they weren't before. SBA is going to automatically reduce the forgivable amount of your PPP loan by the amount of that advance that you got. Remember, the advances were forgivable and they were up to $10,000. If you've got one of these advances, you are not going to be able to have that forgiven and have the same amount forgiven of your PPP loan. So just keep that in mind. I think there was a lot of confusion over that. There's a lot of folks that thought they were going to be able to get 2 sources of free money. That's not the case. You can't double dip, as our friend Dario would say. And again, the overall amount spent on your eligible payroll costs in terms of meeting that 75% threshold, these are the determinants that will determine what amount is reduced of your loan. And then at the end, you'll complete the form, do all the math, and figure out what is our forgiveness amount.
Now, the things that reduce your forgiveness potentially is if you were reducing your employees' pay. So in order to figure this out and demonstrate that you did or did not reduce pay, you're going to list each employee who either earned an annualized rate of less than or equal to $100,000 for all pay periods in 2019. So if they made $19.23 per week or less, they're going to end up on this chart. You also need to list people who did not work for you in 2019, so anybody that's new. And you're going to need to figure their average wage or salary rate for these different time periods. Yeah, we know that's a lot of math, but what it's going to do is help you achieve the maximum forgiveness when you show that either you did not cut pay in the first place or you quickly restored it using your PPP funds.
So what is that math that we need to do? let's talk about the pay reduction, the reduction in pay. And it's quite frankly, and we're just going to be open and honest with you, this is probably the most complicated math that you will have done in the entire process from beginning to end. So for each employee, if the pay is reduced by 25% or more, and this is employee by employee, it's not an aggregate. You can't use all of your employees and say, well, overall our pay was the same. No, it's for each individual employee that you carried over from last year and or that was a new hire for this year that made less than 100,000. Remember, that's the group that we're looking at. If that pay was reduced by 25% or more in your covered period, when you compare that back to January 1st through March 31st of this year, and you did not reinstate that pay level by June 30th of this year, your forgiveness will be reduced by a comparable percentage of what you reduced their pay. So the bottom line, if you use that Paycheck Protection Program money to protect paychecks, to keep the money at the same level as what they were receiving before the PPP loan started, you will get forgiveness achieved.
Now, there is what's called a safe harbor, meaning if you do this, even if you reduce pay, you do this other thing, you can still achieve forgiveness. The first thing is don't have cut pay, right? If you maintain the salary levers that were in place since January 1st or the wage rates, or technically at greater than 75% of what they were, you are in good shape there. Or you can restore those pay rates. Remember, it's free money from the government, good use for it because that's what it's budgeted for. Restore those wage rates to where they were before March 31st and make sure you do it by June 30th. And really, the sooner the better. Now, there is a word of caution because if you gave raises between February 15th and April 26th of this year, and then you cut back once you got PPP funds, the safe harbor doesn't apply to you. You need to make sure that you restore those wages to the new raise level. That's 100% of the new rate. You can't go back to what you were paying before you gave those raises.
So that was the forgiveness reduction scenario one, which is the pay rate. Now we're going to talk about the full-time equivalents. So first, before I go into this, let me mention that number that you put on the form when you applied for your PPP loan, you had to say how many employees you had. Some of you, depending on which bank you went through, filled it out to where it said, how many did you have on February 15th? Others, you used the number based on what was your average employment in the prior year. Depending on when you applied, there was different guidance because this was one of these moving targets. That number does not mean anything with respect to this full-time equivalent. I just want to make that perfectly clear. We're not comparing to the number that you used in the application. And quite frankly, that's probably good news for many of you because of how confusing the guidance or lack thereof was. Some folks used the total number of W-2s issued in the prior year, which of course would be a very high number compared to how many people you have working for you now. So let's just make that perfectly clear that that number is not related to this calculation. So the first step in figuring out your full-time equivalent potential reduction is you choose your reference period. And you have options here. You can choose February 15th to June 30th of 2019. That time period that the bill says is the affected period of COVID-19 in the prior year. What did it look like? What did your business look like last year during that same time period? You can also use January 1st to February 29th of this year. Now think about most farm businesses, that's a pretty low period of employment, something to take note of. And then note the word if you, and only if you applied as a seasonal employer, that is how you calculated your average monthly payroll for your loan application. You may use either of those first two options, or you may use the seasonal period that you used when you applied for the loan, which current guidance has that as a consecutive 12-week period between May 1st and September 15th of 2019. Our hint, choose the one that has the lowest number of FTEs. That will give you the easiest path to avoiding a reduction. Calculate, then you take those numbers, You calculate your average full-time equivalents, which we'll show that calculation in the next slide, for that reference period and your covered period or your alternate covered period. If you're using that alternate payroll covered period to match with your pay run dates, you would use that to figure your full-time equivalents. If you chose not to use that and just use the 8 weeks starting the minute of the day that you got your loan, that is the reference period, or the period that you would use to compare against that reference period.
So how do you calculate a full-time equivalent? Well, good news, if you've been benchmarking with us for a number of years, you already know how to do this. There's a little bit of a difference though with overtime, so let's get to that. If you're just starting out, you're going to list each employee and the number of hours they worked during the time period you chose. So either covered period or alternative period if you chose that one. You're going to take all those hours per employee and divide by 40. And because it's a government program, they want you to round to the nearest tenth. That is your full-time employee equivalent count. Now, you need to cap it at 1 for each employee for this case, right? A job is a full-time job. Even if I work a lot of overtime, I don't count as 1.5 FTEs for this program. So keep in mind, overtime does not increase your FTE count.
So just like we had a safe harbor in the wage reduction, there is a safe harbor for the FTE reduction. So if you reduce your FTEs between February 15th and April 26th, and you restored those to the amount of FTEs you had on February 15th by June 30th, then your forgiveness will not be reduced due to FTE reductions. If you don't meet the safe harbor, the reduction is proportional based on the decrease in FTEs. So, quick example, if you had 100 FTEs in the reference period and you had 80 in FTEs in the covered period, then you would have a 20% reduction in your PPP loan forgiveness. Again, the FTE count, what we're talking about relative to forgiveness, is not related to that employee count you put on your application.
But what if it was the employee's idea to not come back to work? It's one thing if you cut jobs, but what if they just didn't want to work anymore? Well, that's the stuff you need to document, because there are exceptions for you that'll help you achieve forgiveness despite this happening. So if an employee rejected a job, even if you laid them off, but then you made a good faith written offer to rehire them and they said, no thanks, I'd rather stay out and collect unemployment, document that. Right? Their refusal to come to work will impact their ability to collect unemployment, but it will not count against you because you did what you were supposed to do. Now, if we're operating business as usual or as close to usual as we can get right now, there will be people that need to be let go for cause, and there will be people that voluntarily resign. Keep documentation of those as well, because those are normal and ordinary and won't count against you. There may also be voluntary requests to reduce hours, whether that is splitting shifts or whether that is working odd schedules to accommodate childcare or things like that. That is okay as long as you have that in writing. That will not count against you towards reduction of FTEs there. It will not reduce your loan forgiveness. You do not need to even report those positions if you've filled them by new employees, but you do need to document everything in writing, right? And as we hear every day, if it didn't get written down, it didn't happen. So make sure you follow through with that part in your record keeping.
So now the good part, how do we calculate this forgiveness amount? Your maximum forgiveness considers payroll costs first. That 75% threshold that if you've been paying attention to us at all, we've been talking about for quite some time. This is how we calculate it with regard to your forgiveness. You take the eligible payroll costs that were incurred during your covered period or alternate payroll covered period. You divide that number by 0.75, 75%. That will equal the maximum amount that you can have forgiven. The more you spend on payroll, the more of the other expenses you can potentially have forgiven. Spending more than that 25% on those other expenses does not get you more forgiveness. That's the maximum amount of those expenses that you will have, assuming that you achieve 75% of the loan amount on payroll costs. So if you needed to spend, if you had a $100,000 loan, $25,000 is the maximum amount that can be spent on those non-payroll expenses and count towards forgiveness. If you don't spend that 75% on payroll, you won't get that full 25% forgiven either. So that 75% is very important. So if you haven't figured it out yet, payroll, payroll, payroll. Spend money on payroll expenses. If you spend 100% of your loan amount on payroll expenses, you'll be in really good shape.
So, as we said before, if you didn't write it down, it didn't happen. So here's what you're going to need for documentation to prove all of this to go along with your forgiveness application. It needs to be more than your own internal records. Many of you used some internal records as you were applying, but the standard of documentation is going to be higher here. You're going to need records that were processed or acknowledged through a third party, like invoices and receipts, canceled checks, or account statements. What we're recommending right now, start a file for all of this. And as things come across your desk or through your email, pop them in that file so you have less to collect later on. And make sure this is in a safe place, because you do need to keep it for 6 years after the loan is forgiven or repaid in full. SBA is reserving the right to come look at it whenever they want.
So what kind of records do we need to keep for our payroll dollars? You have different options here, depending on how you are paying your payroll. So you need to have bank account statements or third-party payroll service providers. So if you're using a third-party payroll service provider, such as Farm Credit East, if we do your payroll for you, if we use Paychecks or ADP or one of those type of entities, the reports that they provide will be sufficient documentation. You also need to have tax forms or the equivalent third-party payroll provider reports for those tax documentation, and also for the employee counts for those different reductions that we talked about. And again, those periods have to cover all the payroll periods. So payroll tax filings will be reported on IRS on 941. That's what's mentioned in the SBA documentation. What about 943s? Well, unfortunately, we got to stay tuned on that. We're not quite there yet. We need to hope that SBA catches up and realizes that ag labor is reported on 943. And your state, that's an and, that's not an or, that's an and, state quarterly business and individual employee wage reporting. So essentially, whatever you file in your state to document it goes with the payroll taxes that you pay at the state level, that needs to be submitted as well as documentation. Payment receipts, canceled checks, or account statements for your contributions, the business contributions to health insurance plans and retirement plans. So again, some sort of documentation, not your own records. It can't just be a printout of your QuickBooks or your CenterPoint or other software. It has to be some sort of documentation that can be verified by a third party. Those internal records just will not cut it.
So after you're done documenting the dollars, you still need to document the FTEs. And you're going to need to look at the average number of FTEs for one of these 3 periods, depending on how you applied. The first 2, everybody has the option of, if you were a seasonal employer, you can use one of the first 2 or any consecutive 12 weeks between last May 1st and September 15th. Here, you'll use payroll tax filings for the IRS. It does specify 941s. We know there's a 943 issue, because if you don't file that quarterly, because you don't, that's an annual form, it'll take you until after December before you can even get on with your forgiveness application. And I don't think SBA meant to exclude anybody. You'll also need your state quarterly filings, the individual wage reporting that you do, or unemployment insurance filings. Those are going to be additional documentation for FTEs.
So we've mentioned this. I file a 943 and I'm not subject to unemployment. Yeah, we know. Just keep in mind, SBA does not work with farmers. That's normally FSA and other USDA agencies. So they've got to catch up. It did take SBA a while to understand the issue about Schedule C's versus Schedule F's. And so they did eventually catch up. So let's just be patient. If you really are someone that is really concerned about this, go ahead and shoot an email to a regional SBA office. We found that sometimes can get the things moving. But we believe they will catch up and this will sort out before it's all said and done.
All right, so you're going to need a giant chart in tables. You'll see it on the application this way that lists all of the employees who were paid during the covered period or your alternative period, if you chose that, who were residents of the U.S. Notice it doesn't say citizens, it's residents. The first table is going to have those employees who made less than $19.23 a week for every pay period in 2019, or those employees who were new to you in 2020. The second table is going to be employees who made over $19.23 in a week. And the good thing is, if you paid a bonus last year that kicked someone above this amount, that looks like it pushes them to table 2. And that's a really good thing because those employees, you don't have to do the extra math on to talk about the 25% wage reduction test. And if you paid bonuses late in 2019, which made it look like they had a higher wage than they may earn during the covered period, those employees won't count against you because they aren't earning a bonus necessarily during the covered period. And then if there's more than one owner of the business, there'll be a third table. And we'll get more into that when we do the webinar on how to fill out the forms.
So kind of a recap for these forms, what payroll records are we going to need to keep? For each of those tables, you're going to have the employee name, the identifier for that employee, generally the last 4 numbers of their Social Security. What was the cash compensation that we paid to them? Where's payroll? Average FTEs for each of those employees. And then salary and wage reduction based on the formulas that we talked about earlier. And that's only for that table 1. As Erin said, if you have someone that in any pay period in 2019 was over the equivalent of $100,000 a year for that payroll period only, you don't have to put them on table 1. So then you'll compare that covered period or that alternate period versus January 1st to March 31st, and that'll determine the amount of forgiveness that's reduced.
Okay, documentation for some of the things that may more likely be with a third party. If it's internal, you'll need a written lease agreement and canceled checks or receipts. And I don't really mean internal, I mean a private party. So if your landlord is your neighbor, they probably are not in the habit of giving you account statements. So you are going to need that written lease agreement that was in place before February 15th, 2020, and canceled checks or receipts for all the payments that you made during the covered period. If it is a more formalized agreement and there are account statements, you'll need it for February 2020. Remember, we're making sure it was in place before February 15th, going through your covered period plus a month, because that'll help catch up any of those incurred amounts that are actually paid after the covered period ends. And again, this will be on real estate or equipment. Mortgage interest, same thing. If it's a private mortgage, you'll need the amortization schedule and receipts or canceled checks to show not only was it in place before February 15th, but that it has been paid as agreed during the covered period. And you'll need lender account statements if it's a formal arrangement, like your Farm Credit East statement, starting February 2020, continuing through your covered period plus 1 month, so you can show you were in business early enough with this obligation and that what was paid during that covered period. And notice the plus 1 month means you're going to need to wait for a little bit. You're not going to be able to apply for forgiveness on day 57. You're going to have to wait to collect these statements.
So what about our utilities? You'll need those copies of invoices from February 2020 and during the cover period. You'll need receipts, canceled checks, and account statements. So again, if it's your electric utility, that account statement that you have, as long as it's showing the amount that you paid and the date paid, you'll be in good shape. If you don't have, if it's a, say, propane fill up for heating fuel and you don't have a regular account, it's more of an invoice, you'll need to have that invoice and a canceled check to show that you paid the obligation. So again, the eligible utility payments: electricity, gas, water, transportation expense, telephone, or internet access.
So what's next? Really recommend that you get out a calendar and start marking it with these important dates. Start with your covered period and highlight that in a nice bold color so you know what your 8 weeks are. If you choose the alternative period for payroll, document that as well so you know what you're looking at. We also recommend you put your funding date plus 1 month on the calendar. That's a good time to check in and see how things are going. How am I making progress towards goal, and what changes do I need to make? Your PPP funding date plus 7 weeks. That's most of the period has been completed, but you still have a week to make some adjustments if necessary. And then your funding date plus 3 months would be a good time to start compiling all the information and documentation you need to work on your application and apply for forgiveness. Start that file today because those things are going to be appearing, and you might as well get a jump on the work. Begin collecting that documentation. And as a reminder, we are going to host office hours Wednesday mornings from 9 to 10 virtually. You can visit farmcrediteast.com/webinar in order to be able to get the link and pop on with your specific questions so we can get you the answers. Then you can get on your way with your forgiveness application. All right, and now on to Tom, who's going to wrap things up for us and take questions.
Well, great. Thank you, Erin. Excellent presentation by you and Keith. So you folks will notice that we're at 10 a.m. Obviously, there's a lot of material to cover. We're going to stay on for about 10 to 15 minutes and cover the questions that came in during the webinar. But what I would say is that certainly if you have additional questions, keep typing them in. We might not get to them on the webinar here today, but those then become the basis of the frequently asked questions that we're posting to our website. Just a couple notes before I turn to the Q&A. Just want to point out that certainly as you listen to Keith and Erin here, our consultants the last couple months have been working hard on PPP, but they do a lot of other things too. Our consultants are a talented group. They understand farm businesses, and given everything that's going on, could be a big help to your business in terms of just looking at your budgets, looking at profitability consulting. We mentioned some of the benchmark programs that are underway, things like estate planning and family transitions. So definitely reach out to your local Farm Credit East office. We have business consultants throughout our territory who can help you with your concerns. And at the bottom of the slide here, we've got the various other services, including record keeping, tax prep and planning, payroll, et cetera, that you can take advantage of. On the next slide, with just a reminder here, this is the information at farmcrediteast.com, that resource hub. Links, you'll find links to the recordings as well as the frequently asked questions document we mentioned. So please check that out. And then I'm just going to put a quick plug in. Next week, in addition to the office hours that Erin mentioned, Wednesday morning at 9 a.m., we are going to be hosting a series of other basically economic outlook webinars, given all the changes that have gone on with COVID-19, trying to look at the revised outlook for U.S. Northeast and the ag economy. Later in June, we'll have some specific sector webinars on feed grains and dairy, animal protein. We're looking at fruit and vegetable forest products as well. So please stay tuned for those as well. So now I think we will get into the questions. So Keith and Erin, we had probably several questions that came in, I think really kind of in the same zip code, which really has to go to bonuses. So I'll ask it the different flavors of it. So one is that, if someone pays a year-end bonus during the covered period, or if someone pays a COVID-19 bonus, would those payroll expenses count towards the 75% forgiveness threshold?
So, yeah, payroll expense, cash compensation to an employee certainly would be countable expense. There's a couple things I want you to keep in mind, though, if you're planning to do a bonus. I liked the term COVID-19 bonus more than I like the term year-end bonus, because remember, it's we want to make sure that it's attributable to that time period, and we said no prepayments or advances of pay. So I wouldn't call it a year-end bonus. I'd call it a COVID-19 bonus. And the other thing that we want to keep in mind is that we've got to make sure that any compensation, if you're giving the bonus as a means to achieve forgiveness. To achieve that full forgiveness, to get your payroll up over 75% or even to 100%, remember that cap, that 15,385 or that 1,923 per week equivalent. You got to make sure you stay under that amount. That would push you over the equivalent of $100,000 per year in any given pay period. So it may be you want to stretch that bonus out over a couple pay periods so that you get more bang for your buck towards forgiveness. I don't want to discourage giving bonuses to employees. I mean, there's some of you folks, especially in retail, where you have folks interacting with the public. Those guys deserve some extra money because they're at risk, and so don't want to discourage that action. I just want you to do it in a way that's going to benefit both the business and the employee the most. Anything you want to add to that, Erin? Yep.
Yeah, I would add to that. So we're talking about forgiveness and what qualifies, but you're not operating in a vacuum. You know, you still have your employee engagement to be thinking about. So if you can tie those bonuses to specific actions where people have worked really hard and are really deserving of it, as Keith said, you know, retail front lines working with customers, or if someone took on a new project like getting your entire store online so that customers could still shop and do curbside pickup more efficiently, tie it to that so that you not only are putting it in the right time period, but you're encouraging the behavior you want to see more of.
And just on that, so someone else basically said that when they calculated their PPP loan amount off of their W-2s from last year, that included a year-end bonus. Would they be okay if basically they basically included the expected bonus level in basically the weekly payroll this year?
Again, I think it's a matter of semantics. Is that I wouldn't.
I mean, basically, I think they raised the pay to that would get them back to close to what their full year pay was last year.
Yeah. Okay, I see what you're saying. Yeah, I mean, raises, bonuses. Well, I think I'm just going to speak more and not get too deep in the weeds of specifics to timing of bonuses and things like that. Raises and bonuses and any cash compensation to an employee during the covered period counts towards forgiveness. I think that's the main thing we want to do. We don't want to give advances of pay. So if we give a year-end bonus and we call it a year-end bonus in April, it's not the end of the year. That if someone's really scrutinizing that application or the documentation, they're going to say, well, that was an advance of pay. That's not something I would do.
Yeah. And then another one along that line was basically 401k contributions. I think this might have came up yesterday, Keith, that, maybe that's done normally at the end of the year, say, but would it be permissible to say do in the year 401k match sort of based on year to date?
Right.
Something like that.
So if it's a 401k match, again, we need to make it attributable to the time period. So yes, you could early pay a match. However, you can't prepay the match. So you can, a match is very specific language. You're matching their contribution. So whatever amounts the employee contributed during that 8-week period, you can match it during that 8-week period, pay it a little bit early. But and then your discretionary contributions, again, you can do that. If it's a 2% of, let's say you make a 2% discretionary contribution towards 401k, and you normally wait until the end of the year to do it and do it in one check, you certainly can put your discretionary in during the covered period. But again, you're limited to only the amount attributable to that time period. So you can't make the entire year's contribution at once. You can do, essentially rough math, 2 months worth, 2/12 of your annual contribution during that 8-week period.
Okay.
And I think you are going to have to show that you paid it, right, before you can apply for forgiveness. So as long as it happens before the normal due date, you're good to go. But if that's not until December, you might think about accelerating that payment so you can apply for forgiveness before your deferment period runs out.
Okay.
Correct.
So a couple in kind of the owner Schedule C, Schedule F area. One was kind of a technical one here. So basically on the earnings on 14A, if they were not reduced by Section 179 depreciation, do you have to reduce 14A accordingly?
It should have been already. 14A takes your ordinary income, which is also going to have any of the depreciation recapture and those kinds of things in there. So that is the number that SBA guided us to specifically that counts for partner self-employment income.
I think they were thinking that sometimes this is beyond my swim lane, but the 179 is sometimes reported in box 12.
Box 14A is what SBA said. That's what they've been looking at.
Yep.
Okay.
Well, but I'll add to that. And I'll just reinforce that. If you submitted a draft, the guidance did allow you to essentially just fill out your tax return that had not yet been filed and submit it. I just want to reinforce that needs, whatever you submit with documentation needs to match what you actually file to the IRS. So if you filled out your draft and had not taken 179 on that draft, guess what? You're not gonna want to take 179 this year when you schedule your tax return and when you actually file your tax return, because that is going to be something they're going to look at.
So for the amount that that would be counted for forgiveness, kind of a technical documentation question. Should owners actually cut themselves a check in terms of being able to count it towards forgiveness, or is just that amount, understood to be permissible to be included?
That is a fantastic business practice you should be doing anyway, right? Make sure you get paid what you're worth. But as far as forgiveness, no, that amount is already set in stone based on that tax return that you submitted with your application. It is 8/52 of that profit number of self-employment income, depending on which form you file. That is already what counts towards forgiveness as a sole proprietor or a partner. And it does also count towards the 75% payroll cost.
Okay, great. So the next set of questions really come into sort of the other expenses that can be, that PPP funds can be used for. So one of the questions was, if someone did not include, say, interest in utilities, et cetera, when they were applying and kind of arriving at the size of the loan that they applied for, can they still use funds for those expenses? Obviously, up to the applicable limitations.
So that's actually a pretty easy answer. You actually could not include the non-payroll expenses when you applied for a loan. The only thing that was eligible when you applied were payroll expenses.
Okay.
Since they are looking at, that's the genesis of the whole 75% restriction. You applied on roughly 10 weeks of payroll, but yet you're limited to qualifying for forgiveness on 8 weeks. So in order to get that other 2-week equivalent, they've allowed you to throw in some non-payroll. So yes, you didn't have to show anything related to non-payroll expense when you applied, because it wasn't eligible anyway at that point.
Gotcha. So relative to interest, I know one of the things you covered is that the interest has to be on a loan that's collateralized and in place, I believe, before February 15th. The question was, what about the interest on that loan if that loan was subsequently increased? So I believe the loan was in place, but may have been increased following that date. Can that interest be included?
Yeah, as long as it was the same loan, I would say if it's the same account number with the financial institution, I think you'll be fine. Same loan number. If the loan was restructured and you have a new loan number, then that's going to give you trouble because it's not going to match.
Yeah. Right. New promissory note after the date.
Right.
Trash and recycling expenses, would that be considered a utility?
Not on the list.
And someone asked, they have separate EINs for in their business. They're asking if they can include payroll expenses from both companies.
Did you apply that way? There was an early provision that allowed you to combine your applications, which is just a nightmare for documentation and recording. But they're going to tie whatever EIN you applied with to where you report your payroll. the forgiveness
So
period.
it really depends on how you applied, then, is what you're saying.
Yes.
Okay. And I think this is going to be the last question here. This gets to the FTE calculation. So someone who's on salary, do they count as a full FTE even if they didn't or maybe don't usually work 40 hours?
I believe, if I recall reading, that salary employees automatically count as one.
Okay.
It's sort of just an automatic.
Great. Well, super. Well, I think we're going to wrap it up with that. Again, thanks to Erin and Keith for their presentation. Obviously, great information, a lot going on. And so certainly stay tuned. Remember those office hours, Q&A. If you have specific questions, that's Wednesday, next Wednesday at 9 a.m. Go to farmcrediteast.com/webinars. You can sign up for that there. And again, the plan is to hold those on Wednesdays going forward to get people's questions answered. I would just say certainly it's a difficult time in our country with everything that's going on. It's Memorial Day weekend. We certainly think of those who've given their lives to support the freedoms we have. We definitely thank all those on the front lines, the healthcare workers and first responders, but also the farmers, our members who are out there providing food to everyone that we enjoy. Certainly those are things we appreciate. And so hopefully everyone has a good Memorial Day weekend. And thank you for participating.